Here's what's wild about the economy right now. Prices are high but cooling, jobs are strong but slowing, and everyone's trying to figure out what comes next. The Federal Reserve is at the center of all of this.
The Federal Reserve is the world's largest central bank.
The Federal Reserve is one of the most powerful players in the economy.
At the top of any US dollar bill, you'll see this.
The US is the locomotive of the global economy.
Money printer go brrr.
It controls the supply of money, and through that control, it influences aggregate demand in the economy.
The Fed provides short-term loans to banks so they have enough money on hand in times of financial stress.
One of the Fed's most recognizable functions is conducting U.S. monetary policy.
As a former chairman once said, they're the economy's chaperone who has ordered the punch bowl removed just when the party was really warming up.
The Fed's leaders see a slowdown coming in the U.S. job market.
The time has come for policy to adjust.
There's a huge trust factor, and therefore the dollar is seen as the world's reserve currency.
Through its influence on the U.S. money supply, the Fed has more power to affect the economy than any other institution.
The story of the Federal Reserve. They have to balance price stability and maximum employment, making sure that things aren't too expensive and that everyone who wants a job can have a job.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
I had questions, a lot of them. So I sat down with someone who might have the answers, Mary Daly, president and CEO of the San Francisco Fed. She's one of the people actually making the decisions that affects your money. Hi, President Daly. Thank you so much for talking with me today.
Oh, it's always my pleasure. Thanks for having me.
There were 5 big things that I wanted to understand. Number 1, why everything still feels so expensive. Number 2, what's really happening with jobs. Number 3, why Wall Street and Main Street feel like different planets. Number 4, how the Federal Reserve actually makes these massive decisions. And number 5, whether they can actually fix this. Let's break each one down. Before we dive into today's economy, we have to understand how we actually got here. And that starts in 1913 when things were wild. In 1906, an earthquake destroyed San Francisco. Someone tried to manipulate the price of copper, which ended up creating a cascade of bank failures and a crash in the stock market. If a bank went out of business during this time, everyone lost money. So people would go to other banks, try to withdraw all that money, and it was a series of repeated failures. JP Morgan had to bail everyone in the financial sector out. People were literally losing their life savings because there was no central bank to stabilize things. Congress was like, we need to fix this.
So in 1913, Congress created the Fed. And it's really important for everybody to know that Congress created the Federal Reserve. And when Congress created the Federal Reserve, they wanted to ensure that the entire country's voices were heard.
So in 1913, President Woodrow Wilson signed the Federal Reserve Act into law, creating the Federal Reserve System as the central bank of the United States, creating a bank for banks. This legislation was designed to provide the nation with a safer, more flexible, and more stable monetary and financial system.
And so they created what we call a federated system. And our federated system looks like this. We have 12 reserve banks, and the reserve banks' heads, their presidents, leadership, are selected by private sector and community boards of directors. So they have that sort of community-based or business-based choices on leadership. And when Congress put this together, it was intended to really reflect everyone so that it could make decisions that were good for the entire country, the country as a whole.
Ensuring decisions were good for everyone, not just specific regions. These 12 regional banks are spread across the country, Boston to San Francisco. Each region has its own president who knows what's happening on the ground in their local economy. Because let's be real, what works for New York might not work for Kansas City. Each regional bank is an independent corporation overseen by its respective board of directors. There are 2 banks in Missouri, by the way, St. Louis and Kansas City, because a representative from Missouri was instrumental in passing the Federal Reserve Act. President Daly continues.
Then we have the Board of Governors, and that's located in DC, and members of the Board of Governors, including the chair of the Fed and the other governors who are on that board, they're nominated by the executive branch and confirmed by the Senate.
The Washington-based Board of Governors helps to oversee the Federal Reserve System. Since 1935, it has consisted of 7 people, including a chair, each of whom is nominated by the president and confirmed by the Senate. The governors serve on the Federal Open Market Committee, which includes 5 Reserve Bank presidents who decide interest rates. President Daly emphasizes this.
The reason they wanted to do that was to ensure that there were durable decisions made about the economy and that the participants in the Federal Open Market Committee always put the American people and, importantly, the goals that Congress gave the Fed first.
The Federal Open Market Committee, or FOMC, is the group that decides what happens to interest rates. They meet 8 times a year, and when they do, markets everywhere hold their breath.
So right now, Congress is for the last half century, Congress has said to the Fed, you will deliver price stability and full employment. And that is the journey that we're on. Price stability, full employment, doing what Congress asked us to do on behalf of the American people. The other thing that Congress did in 1913 is they insulated the Fed. So it needed to be independent from changes in the administration.
This independence is everything, because monetary policy isn't about winning elections. President Daly explains the role of independence at the Federal Reserve.
The other thing about independence is it ensures that the participants in the Federal Reserve are not swayed by their political leanings, that when you walk in that room and you close the door, you cross that threshold, you're going to deliberate about how to achieve our goals that Congress gave us, price stability and full employment. Political views are put aside and we don't think about them. We don't talk about them. We focus on how do we achieve the goals that Congress gave us? And I think that sense of being independent and uninfluenced by political views actually allows us to create tractable and durable decisions over time. And that's really important. It allows us to be accountable to the American people and to Congress on the goals that we have. And as you know, the chair of the Fed is asked to go and testify in front of Congress twice a year and talk about the work that the Federal Reserve has done and how the Federal Reserve actions are in line with what Congress has asked us to do.
Those goals can only really work if the Fed is independent.
And that is the journey that we're on. Price stability, full employment, doing what Congress asked us to do on behalf of the American people. And this is a system that's worked so well that other banks, central banks around the globe have moved towards an independent central bank that reflects the views of the broader economy and society.
What does price stability actually mean? The Fed's aiming for 2% inflation, not 0, not 10%, but 2%. It's like a Goldilocks number. We aren't quite there yet, as President Daly explains.
Inflation's still printing above our 2% target, so we need to continue to work to bring that down.
A 2% inflation target provides some buffer for the Fed to lower interest rates during economic downturns. When inflation is at 2%, it's low enough that you don't really have to think about it, but high enough to give the economy some flexibility. 2% allows households and businesses to make sound decisions regarding saving, borrowing, and investment, contributing to a well-functioning economy. Inflation that is too low, below 2%, can actually weaken the economy. It can lead to a cycle of ever lower inflation and inflation expectations, which is difficult to overcome once it sets in. Remember, a lot of monetary policy is psychology.
In fact, the Fed's communication is another important tool the Fed has to influence the economy. For instance, the Fed has very important psychological effects on the market through its talk, its posturing, and its announcements.
And a lot of managing inflation and managing the labor market is simply talking to people and being as transparent as possible, President Daly explains.
The broader trend going on well before social media came to be an important platform was for the Fed to be more transparent. That started, long ago. Used to be not transparent at all when I started working at the Fed in the 90s, not transparent at all. Really just a single voice and not very transparent about the reaction function, how we think about things, how decisions will be made. But over time, transparency became something that speaking openly about what we're doing, why we're doing it, and what we expect to do going forward. It became something that was important because it helps consumers, businesses, the American people, that helps them participate in the economy. So saying that we have a 2% inflation target and we are committed to getting inflation back to that helps inflation move to that target faster. So that became something that's important.
Managing inflation expectation, or what people expect to happen, is a big part of monetary policy.
When social media comes, it gives us an additional platform. It can also create, some would say more noise, but I just have a sense that the noise comes from it's a new thing as people get more familiar with how to get the information that rises above that, they get the storyline. But seriously, most people have moved to some sort of digital communication to get their news. And when they move to digital communication, we need to be in that space. And I think that's the best way to keep our commitment to reach as many Americans as we can and let them or their spokespeople, you would be like a spokesperson for so many questions, ask us questions that we have to answer so that we can be accountable and explanatory and give assistance. I mean, I think that's the job, and we need to live up to it.
So now we understand how the Fed works, but this institutional framework matters most when it's tested, and right now we are living through one of those tests. The Fed has these two mandates, price stability, maximum employment, and while employment's looking pretty good, prices are the story that's affecting everyone. You feel it at the grocery store, at the car dealership, in your rent. This disconnect between inflation is cooling and why does everything still cost so much is exactly what I wanted to talk to President Daly about. Because sometimes the data says one thing and lived experience tells another.
Inflation technically is the change in the price level. But what people live and experience is not just how rapidly prices are growing, but how high they are.
So let's talk about what inflation actually is. Picture prices like water levels. Inflation is how fast the water is rising. Price level is how high the water is now. Deflation is when the water level is dropping, which is rare and usually bad. You'll know this if you ever go to a dam. Right now, the water is rising more slowly, inflation is cooling, but we're still at a high price level. And that's why everything still feels expensive. It is.
If you think about inflation, it isn't just about where we are today. It's about where we were for the last 2 years or 2+ years. When inflation's high, and as it was, and it's persistently high, what we saw was real wages fell because inflation was rising faster than wage growth. So people were falling behind, and they've accumulated all this falling behind period so that they're now farther back on the economic ladder than they were when the pandemic started or when we started tightening the interest rate.
Real wages, that's what your money can actually buy, or wages adjusted for inflation. That buying power has taken a hit. Think about it. If you got a 3% raise but your rent went up 10%, you're not exactly winning. And the Fed knows that. And wages are catching up as American Progress reports, but it's difficult. As AAP said, most importantly, inflation-adjusted wage growth has been strongest for the lowest income workers, whose real wages are 16% higher than they were before the pandemic. Wage growth for low-income working Americans has been so much stronger than for other groups that has led to a decline in wage inequality, undoing roughly 1/3 of its growth since 1980, right before Ronald Reagan became president. Undoing Reaganomics is quite impressive, but there is still work to do, as President Daly explains.
What is likely to happen? What's likely to happen in history would be our guide here. What's likely to happen, same thing that happens across the globe, but here in the United States historically, is that wages catch up to where the price level has risen. And then people feel like, okay, this makes sense. I'm back on my footing, and I have everything I had before the pandemic, and now I've even got more. But that hasn't happened yet for the vast majority of Americans. And until it does, people are going to feel like inflation stole something from them.
And inflation did steal something from them. It stole something from everybody. For a lot of people, inflation has totally warped their ability to buy a home, afford childcare, afford elder care, etc. We talk about this all the time on this channel. And it's all compounded over the past several years. It's the asset economy versus the wage economy, where those that already have a house or have a lot in the stock market, they're doing okay. But if you're trying to get one foot on the rung of the ladder, you're having a hard time.
Everyone seems to buy eggs, and I understand that. I like eggs too. And they're just more expensive than they used to be. But it's not just eggs, it's housing, it's cars, it's variety of things that now cost more. And people don't feel like their wages and their earnings have gained the same amount as their prices have. So that's why people feel inflation is still important, and I would agree with them.
And this just isn't about breakfast, right? It's not just about eggs, it's about rent, cars, childcare, the building blocks of daily life. And while the Fed talks about percentages and basis points, people are talking about whether or not they can afford a house, if their raises are keeping up, how to plan for the future when everything costs more.
What I have seen, or what I understand, and what I hear is that because we target inflation, the remedy for that price level being higher than wages have caught up to is to create a durable expansion. That is actually how this works.
So basically, the Fed's monetary policy equation is to target inflation, make things not so expensive so fast, to maintain a balanced labor market so wages can catch up, so we have a durable expansion. A durable expansion is the economy growing steadily over a long period, not too hot, not too cold. Fast enough for wages to catch up, but not so fast that prices spiral up again. But of course, it's hard.
What historically happens in an economy, especially one that doesn't have a severe recession, is that the price level doesn't go down, but wages catch up. So the eggs don't feel 3 times as expensive as they once were because your wages are more than 3 times as high as they once were. We're not there yet, but that's how it typically works. Now, some prices are going to come down as things normalize, but by and large, the way we dig out of the period of high inflation is we have this durable expansion that allows incomes to catch up to where price levels have risen. And that allows people to put this episode behind them and focus on other things that are important.
And it's psychological too, as President Daly talks about.
So I can't address the real question, which is, can the price of eggs go down? Because that's what really people want, but that's not what is likely to happen.
This is the tough part about inflation that doesn't get talked about enough. While some prices might come down, used cars, energy costs, most prices don't usually drop back to where they were, unless we go from the supply side angle with things like increasing spare capacity at ports, utilizing the Strategic Petroleum Reserve, building buffers for critical minerals, and implementing policies to curb price gouging and windfall profits, none of which the Federal Reserve is in control of. That's all fiscal policy. And we have seen a lot of improvements in fiscal policy addressing these things, but that could change with the coming administration. It could be improved by the coming administration as well, but that's the balance between monetary and fiscal policy.
So it's going to take time for them to regain what they lost and then grow past that. And I think that's what people are feeling. At least that's what they're telling me is, the price level is still high, despite the fact that inflation's coming down to more to target.
The price level is still high, and that's the entire problem with the inflation fight. Everything feels so expensive for 3 main reasons. Number 1, the price level. Number 2, the wage gap. And number 3, the psychology. The Fed was raising rates for a long time in order to battle these 3 things, but it works like dominoes. Domino number 1, the Fed raises rates. Banks pay more to borrow. Banks charge more for loans. Domino number 2, borrowing gets expensive. Mortgages cost more. Credit cards cost more. Businesses' loans are pricier. Domino number 3, people and businesses spend less buying, less hiring, less expansion. Domino number 4, prices stabilize. Companies can't raise prices as easily. Wage pressure eases. Inflation slows. But here's the catch. These dominoes all fall at different speeds. That's why it takes time to see results. So we've got domino 4, and the Fed held rates steady for a while and recently began cutting. They cut by 75 basis points so far, primarily because of what we've been seeing in the labor market. A real soft landing isn't just about avoiding recession. It's about creating conditions where people can actually recover what they lost. Remember the economic ladder that I mentioned earlier? Getting your foot on the first rung of it? People need to actually be able to climb back up and then keep climbing, and getting inflation to 2% is how the Federal Reserve sees that happening. But it's also about maintaining a stable labor market.
So the labor market has come into much better balance. If you think about the vacancy to unemployment ratio, it's about 1 job per 1 unemployed worker. That's a substantial improvement from the times when we had over 2 jobs available for each worker, and that meant that the pressure on inflation is coming down. So I see the labor market now as being a place where workers can find jobs and employers can find workers. That's the kind of balance we need to really achieve that price stability we've been marching towards.
A lot of labor market metrics are coming into balance. We had a hot labor market for a while where there weren't enough workers to fill jobs, but that's shifting. This vacancy to unemployment ratio is actually super important. Think of it like a job thermometer. When there are way more job openings than job seekers, you get wage pressure, which can feed inflation. 1-to-1 is kind of the sweet spot. But the language we use to describe it matters, as President Daly said.
Now, when we use terms like the labor market is solid, I think that leaves a lot of people saying, well, I don't feel that. What it really means is that the labor market is balanced. It is continuing to expand and people are continuing to find jobs. The unemployment rate remains relatively low by historical terms, and employers can find workers. And that's the balance we need, again, to really achieve price stability. So a good labor market, but not the frothy one or the robust one we had just a couple of years ago, which was contributing to high inflation.
The labor market has to be balanced, not too hot, not too cold, just right. And maximum employment is when anybody who wants a job can have one.
And at that point, with inflation coming down, it's appropriate to lower the policy rate to get it right-sized for the economy that we saw emerging. That's just an adjustment that we needed to make sure we weren't over tightening and contributing or causing that weakness that we don't want to see. I don't want to see weakness in the labor market. That would be something that at this juncture would feel unnecessary for achieving our price stability goal.
The Fed thinks we're still moving forward, just at a more sustainable pace. But what does that actually mean? The goal is to make it so that people can still keep finding jobs, keeping jobs, getting raises, and having options. So President Daly explains why they started cutting rates in order to preserve all that.
And at that point, with inflation coming down, it's appropriate to lower the policy rate to get it right-sized for the economy that we saw emerging. That's just an adjustment that we needed to make sure we weren't over tightening and contributing or causing that weakness that we don't want to see. I don't want to see weakness in the labor market. That would be something that at this juncture would feel unnecessary for achieving our price stability goal.
They're cutting rates because they don't want to overdo it. They want to move as quickly as possible to the data shifts in the economy so they aren't caught behind the ball.
I see the labor market as achieving that balance, which means it can keep going at this level. We can keep having job growth, we can keep having labor force growth, we can have wage growth at productivity plus inflation. That is a sustainable pace. And that is what I'm really after, is a durable expansion with price stability. And that's within our grasp.
When President Daly talks about wage growth at productivity plus inflation, she's describing what an actually healthy economy looks like. Your wages grow not just because prices are rising, but because you're actually more productive at work. That's sustainable. That's durable. Everyone keeps talking about this soft landing, but let's be real about what that actually means. What we've seen is the fastest rate hikes since the 1980s, tech layoffs and bank failures, record high stock market, and still hot prices. What success looks like is inflation at 2%, low enough to ignore, high enough for flexibility. The job market stays healthy, people can focus on careers, not prices, and wages actually catch up to these higher prices. And for the Fed, they're getting closer and closer to landing the plane, but there are still some headwinds.
When I talk to people, when I'm out in my community or anywhere in the 12th district or the US, what I hear again and again is return to a place. Here's what normal feels like to them. Normal feels like inflation's around 2%, and the job market's continuing to expand, businesses are opening, I can get jobs, and I can focus on not the economy, but my career, my family, my community.
The best monetary policy is almost invisible. It's working when you're thinking about your career goals, not whether or not you can afford groceries. President Daly highlights.
That's what people want to be able to focus on, and they've been completely crowded out from those types of thoughts by trying to focus on how do I pay for things because inflation's so high, and as inflation comes down, how durable is the labor market? Will I continue to have work, and will I continue to find jobs and grow my career? So that's what we're up to. That's what a soft landing would mean to me. And that's what I'm devoted to trying to achieve.
And here's what's wild about the last few years. The economy became the main character in everyone's story, and not in a good way. When people are constantly calculating prices or worrying about jobs, something's off balance, and that's part of the problem now. But there's another layer to this. Markets are hitting record highs while people are still struggling with these high prices. This disconnect between Wall Street and Main Street is exactly why the Fed has to look beyond the headlines.
The most important trait of a central banker is to be studying the boat. Don't get caught up on euphoria or too much pessimism. Just stay studying the boat and data dependent, evidence based. So I'm going to wait for the evidence to come in, and also, things to evolve a little bit more than they are. Whether it's thinking about how AI affects the economy, or thinking about how the new administration, the incoming administration, changes things that might affect the economy.
This might be the most important thing to understand for the Fed right now. They can't get swept up in the market excitement when stocks are booming or panic when there's a bad inflation report.
We have a lot of things to understand, and I think we need to take our time to understand them well. You know, there's always this idea that if we don't understand them today, we'll be behind. But changes in the economy aren't usually light switches. The pandemic was sort of a light switch. One day we were okay, and the next day we're in a pandemic. But by and large, policies, the evolution of the economy, it happens more gradually, and you have time to understand it and then make decisions that are right to help the economy, well, in the Fed's case, help us achieve our congressionally mandated goals.
So we've talked about inflation, jobs, and monetary policy, all these big economic forces. But at the end of the day, these forces affect real people making real decisions about their lives. I think that's why Mary Daly's personal story is so powerful. She knows what it's like to deal with uncertainty.
Well, the most important advice I can give is to have perseverance. You know, persevere, be resilient. And just so your listeners don't think, or your viewers don't think, that I just have some book of platitudes here that I look through to give you that answer. You know, I base that, I'm informed by my own experience, my lived experience. I had a very unique path in my life. I didn't graduate from high school. My family had an economic shock. I then am struggling to know what I'm going to do. And it wasn't a tremendous, it didn't feel like opportunities were everywhere. But over time, I just kept going one thing at a time. And importantly, and this is really important, I listened to people, usually who were older than me, who could see something from their experience that could give me hope and optimism. And so I want to do that for you here. I'm going to say that, you know, this is just one of the many fluctuations and uncertain periods in the economy you face. If you can persevere through this one and invest in yourself, your skills, your abilities, your you know, if you want to think about buying a house, keep saving for it. The time will come. If you want to keep thinking about how to build your career, keep doing things that contribute to it, even if you don't have exactly the job you want, you'll get it. And keep doing those things, because over time they accumulate. And you look back and people say, wow, you had a unique path, but you had a very good path. And that's how you'll feel at the end. So that's my advice. Be resilient, persevere. And if you run out of hope on any given day, just think, you know, Mary Daly, president of the San Francisco Fed, says she's got your back.
There's a lot of uncertainty just across the board. Jerome Powell has made it clear that the Fed is in no hurry to cut interest rates. The Fed is data dependent, and they're trying to figure out exactly what is happening with the data. And so where we are right now is prices are not going back to 2019 levels unless there's some serious supply side support. The job market is shifting, it's not crashing, and the Federal Reserve is still trying to stick the landing. And regular people are caught in the middle of all of this. And I think that's what makes the last 2 years so exceptionally difficult. We talked about it in the video, but there really is a disconnect between assets and wages. If you've been able to experience the stock market rise, you're in a little bit of a different position than if you've just been relying on wage growth. But hopefully some key takeaways from this video are why the Fed exists, why it's important that the Fed maintain independence in either a Democrat or Republican party running the House. It doesn't matter. The monetary policy of the arm of the government should remain independent. It's also very important to have supportive fiscal policy in order to help battle inflation. And hopefully there was a lot of information about how the Federal Reserve is thinking about the labor market and inflation and where we could be headed in the future. Everything is up in the air right now, and we'll see what happens over the next few months. You can find my work across TikTok, YouTube Shorts, Instagram Reels, on LinkedIn. I have a Substack, Kyla.substack.com, as well as a podcast called Let's Appreciate. I, of course, have this YouTube channel if you want to like and subscribe. That always helps. And then I have a book where I wrote extensively about the Federal Reserve and monetary policy if you want to check that out. Huge thanks to Mary Daly for providing her time with this interview and all the knowledge that she shared. I think it was pretty helpful. And I hope that you all are doing okay out there. I will be back with a Thanksgiving Day themed video, the economics of Thanksgiving and Black Friday, in the next few days. But I hope you all are doing okay out there, and I'll talk to you very soon. Bye.